Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, May 13th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are dovish signals from China versus hawkish signals from Japan. So the nuance there is that the latest credit, CBI, and PPI data from China were supportive of our China front-loading stimulus theme in that they signal an economic recovery struggling to achieve escape velocity. Elsewhere, the BOJ announced its first planned reduction in bond buying since late December. The central bank will buy 425 billion yen of 5 to 10-year JGBs, down from the 476 billion of planned purchases last month. In terms of market implications, although we maintain that Beijing is pushing on a string with respect to its policy prescriptions, specifically favoring monetary stimulus over fiscal stimulus, we do believe that they will continue pushing on said string until economic conditions materially improve. That outcome may be a long ways away, as evidenced by the first outright contraction in total social financing since October of 2005 in April. Elsewhere, the pullback in bond purchases potentially marks a shift in the BOJ's laissez-faire attitude towards Japan's collapsing currency, which has plunged in recent months to the lowest exchange rate versus the US dollar since the early 1990s. The BOJ following through on this shift could come at an awkward time for asset markets from the perspective of adding to global bond market volatility alongside the hawkish net financing policy pivot by the US Treasury Department. Q3 could be an especially volatile quarter in this regard. As always, transitioning to our 42 macro dashboard here. Wrapping up with the question from our community. This one's titled Sooner Than Expected. Said, hi, Darius. There are some people arguing that inflation indicators lag behind. We are certainly one of those people, suggesting that the next report might show low inflation. Coupled with slowing employment, they predict the Federal Reserve will cut interest rates sooner than expected, surprising the markets. How accurate is this opinion? Are there logical reasons supporting the possibility of a sudden rate reduction? Thank you for your valuable time. So let me just kind of go through that. So let me go through each step by step here. So inflation indicators lag behind. That is correct. Inflation is the most lagging cycle within the broader business cycle. So we've argued that the Fed, in response to either a combination of sticky inflation and a significant loosening of labor slack in the labor market, we think they would cut rates in that regard, and that would be the appropriate thing to do because the employment cycle is a leading indicator of the inflation cycle. There are other cycles that lead the employment cycle, but you have to understand the progression of cycles within the business cycle, and inflation is the most lacking of those. So the Fed is correct to identify and be focused on employment here in terms of guiding its monetary policy and forward guidance here as opposed to inflation. Coupled with slowing employment, they predict the Fed will cut interest rates sooner than expected, surprising markets. How accurate is this opinion? We can't ascertain how accurate that opinion is, from an ex-ante perspective, because none of us knows the future. But it's a reasonable thing to expect if we have a significant slowing of employment from here. We're starting to see, very starting to see some leading indicators show a more material loosening of labor market conditionings. So we have not seen a preponderance of indicators support that view, but we are starting to see some indicators support that view. So in our opinion, I don't know that we are able as investors to have a real high conviction view on that yet. We need some more data to adopt a different theme there. And then are there logical reasons supporting the possibility of sudden rate reductions? The answer is at this current juncture, no. The labor market is by and large remains resilient based on the preponderance of the latest data. We do, as I mentioned, are starting to see some indicators that the labor market might be slowing at a more expeditious pace in a way that is negative for growth. And if that's the case, if we start to see that permeate across more indicators across the balance of data, then that would support the possibility of a sudden rate reduction. So as always, in our opinion, again, if you're focusing your entire investment process on whether the Fed cuts rates in June or July or September or November, God help you. I have no idea what to say to you, but that's not going to be a very effective solution, particularly when you get into 2025, because we're not going to be talking about if they're going to cut rates in June or July in 2025. So we would recommend you find a more robust, defensible research and risk management process to help guide your portfolio through these highly uncertain times. I was on Fox Business last week, and we were talking with our friend Charles Payne about how the growth, inflation, and policy fundamentals, which were ubiquitously bullish from the start of the bull run in November to, let's call it, say, mid-March, have really started to move in different directions. And from my perspective, I think it's very difficult, even for someone as sophisticated as myself, to understand how asset markets are perhaps price in the changes in those fundamentals. In my opinion, I think it's really important to lean on your risk management processes in confusing times like this when the fundamental narrative is less clear for asset markets. And I can tell you right now, if the only thing you're focused on is the Fed cutting interest rates in June, July, August, September, October, November, December, I can tell you you're probably not going to make very much money trading asset markets. So definitely find somebody who can help you with that, expand your investment process. So we'll wrap it up there. Darius Dale presenting our Macro Minute for Monday, May 13th, 2024. Best of luck out there today. We'll catch you back here tomorrow. Cheers.